Hello, Dr. Tim Creel here. Wanted to talk a little bit about Chapter 5 of Auditing, which relates to internal controls. So go ahead and share my screen here and pull up the presentation. So, start the presentation. There we go. Okay, so internal controls are a very important element of auditing, and they're really a very important area of business. Internal controls are one of the things that in many, many areas of accounting that you work in, you're going to deal with internal controls. If you're an auditor, you're going to deal with internal controls. If you want to work for a company and become a controller or a CFO or an internal auditor, you're going to work for internal controls. Pretty much the only place I think you might not see them much is tax. But other than that, you're going to see internal controls. You're going to work with internal controls. One of my favorite jobs was as an internal auditor, where I got to work quite a bit with internal controls. And as a controller, I also got to work a lot with internal controls. So, kind of a definition: a process affected by an entity's board of directors, management, and other personnel designed to prevent reasonable assurance regarding the achievement of objectives and the reliability of financial reporting, effectiveness of operations, and compliance with laws and regulations. Good definition right out of the book. Now, the Sarbanes-Oxley Act of 2002, it basically really put more pressure or really changed the audit industry. It basically came after Enron and the Enron scandal. And one of the things it said is that companies now have to have an audit of the effectiveness of their company's system of internal controls. So before Sarbanes-Oxley, companies just had their financial statements audited. After Sarbanes-Oxley, now they have to have a dual audit, one both of their financials, but also of their system of internal controls. So integrated audits for all publicly traded companies. This was kind of the result of Sarbanes-Oxley. And Sarbanes-Oxley really changed a lot in terms of internal controls. Basically, after Sarbanes-Oxley, a lot of companies had to do quite a bit of updating to their controls. They had to hire internal auditors, increase the size of their internal audit staff, put in more controls within their IT system. Companies had to spend a lot of money after Sarbanes-Oxley to make improvements to their system of internal controls within their company. It created a lot of jobs for accountants, especially in areas like internal audit, and IT audit. It really did. And so the auditor should verify controls for areas of fraud risk. So the auditor is basically going to look at internal controls to see, will they stop fraud? Will they help prevent fraud? Are they effective? Are they working? Now, the audit evaluates the company's system of internal controls in the planning phase. So when you're doing an audit, when you're planning the audit, one of the big things you're going to look at is the company's system of internal controls. And you're kind of it kind of serves two purposes, really. You're fulfilling the aspect of auditing the effectiveness of that company's system of internal controls, but you're also looking at how much can we how much how reliable is the company's system of internal controls in terms of their financial statement audit. So it's really kind of a dual purpose thing when you're looking at it in the planning stages of the audit. Now, here's where it really comes into play when you're looking at the financial statement audit. Less reliance on internal controls, higher control risk, lower detection risk, more effective test, more substantive test, more testing performed at year end, and higher sample size. Now, less reliance on internal controls means that the company that you're auditing, their system of internal controls is not as effective as it should be. It means that it's not totally effective, that you can't totally rely on it. And based on the degree of reliance on their system of internal controls, it really changes the way you do your audit. So you have higher control risk, lower detection risk, which means that you have to do more effective test. You have to do more substantive test. So you have to test more things instead of having greater reliance on the system of internal controls. more testing performed at year end. So and you'll notice the difference between these two when we talk in a moment about more reliance on internal controls. And you have to have larger sample sizes. So you've got to do more proof to prove the financial numbers if you can't rely on the company's system of internal controls. More testing at year end, higher sample sizes, more tests, such as more confirmations instead of, maybe verifying something internally. So you end up having to do a lot more work on the financial audit if you feel like you can't rely on that company's system of internal controls. Now, if you can rely on their system of internal controls, you have lower control risk, higher detection risk, less effective tests. So basically, you could basically prove numbers on the financial statements with less effective tests. Now, with any testing that you do as an auditor, you have to feel certain that, okay, we have verified this number, with professional skepticism, and that you've properly verified the number. It's just, if you can rely on their system of internal controls, sometimes it's easier to feel comfortable about your verification. And it might not take as stringent a methods as if you can't rely on their system of internal controls. More testing can be performed during interim periods, kind of throughout the year, and lower sample sizes would be allowed. So think about it this way. It makes your audit a lot easier if you can rely on their system of internal controls. If you can't rely on their system of internal controls, your financial audit is going to be a lot tougher. It's going to take you a lot more time, a lot more tests, going to be a lot more stringent tests, which typically mean like more confirmations with outside third parties and the like. It's going to be a very different audit depending on whether you can rely on their internal controls or not. And so again, during the planning phases, you look at their internal controls to look at how effective they are. And not only are you verifying this for the integrated audits, both financials and internal controls, but also how much can you rely on the company's system of internal controls for the financial statement audit? So kind of a dual purpose there. The COSO framework. Internal Control Integrated Framework works within the goals and objectives of the company. And so the framework, like the COSO framework, basically what it is several different accounting organizations came together, several years, probably 20 years ago. And they basically set up a framework that companies could use to create a system of internal controls or improve their system of internal controls across their organizations. It was like the American Accounting Association, which is for accounting educators, the IMA, the Institute of Management Accountants, the AICPA, the IIA, Institute of Internal Auditors. Several different accounting organizations came together and built this framework. And over the years, they've updated it, expanded it. And it's a very applicable framework that companies can use to help build their system or improve their system of internal controls. Now, it starts off with the control environment. And the control environment might be the most important aspect of internal controls. It's the tone at the top. And basically, if you go back to a lot of the cases of fraud that occurred with accounting fraud that occurred like around the year 2000 or the late 1990s, Enron and WorldCom, all of them were led from the tone at the top. And so what you see is whatever you've got at the top works its way down through the organization. If you've got very ethical, strong leadership, do things the right way type management at the top of the organization, that's going to flow throughout the company, because employees that don't do that typically won't stay with the company. Either they'll be asked to leave or they'll leave themselves. If the tone at the top is very unethical, do whatever it takes to get the job done, don't care about bending the rules, then basically that's what's going to flow down through the company. And like I said, with Enron, WorldCom, that's basically what was found. Now, characteristics of a well-functioning internal control environment: integrity and ethical values, board of directors, a board of directors that's very active in maintaining integrity controls throughout the organization, establishing controls throughout the organization, management's philosophy and operating style. One thing I'll say about this is when you're auditing a company, look at their system and how they do performance evaluations, for example. Um, how do they give bonuses? How do they give raises? That is a good thing to look at as an auditor, because if a company is extremely cutthroat, like they put a very high level of employee salaries based on bonus, and basically they set very high goals that are hard to reach, then you've probably got a operating style going on within the company that some employees might be doing anything to hit those goals. And so sometimes you got to look at management's philosophy and operating style when you're planning your audit. Because if it's like, for example, I'll give you an example here. Enron, their performance evaluation was like nothing I've ever seen in my life or heard of in my life. Basically, every year they evaluated all their employees and they rated them, based on 1 to 100, 100 being the top, one being the bottom. If you were in that bottom 20%, you were automatically terminated. And so they created such a, dog eat dog environment within their company that you kind of would have to expect it as an auditor that employees are going to be doing whatever it takes, whether it breaks the rules or not. Now, the organizational structure. A big thing here is looking at, where does internal audit report to? Internal audit should report right to the audit committee. The audit committee is a separate aspect of the board of directors that hires the external auditors, deals kind of as a go-between between the board of directors and the external auditors, but also should work directly with the internal auditors, or if not with the audit committee, with the board of directors itself. If internal audit goes to the president or reports to the president or the CFO, you have a great chance that the president or the CFO could influence their activities. So again, organizational structure can make a difference. Financial reporting competencies, the competencies of your CFO, your controllers, authority and responsibility, basically broken out across the company. And what are your human resource policies? What goes into hiring? You know, most university positions that I've held in the past, you have to go through not only you have to go through a background check. That's part of it, to make sure that there's nothing in my background that would make it to where I should not work in a university setting. I passed so far, which is good. But anyway, what are your human resources policies as far as hiring? That's just one aspect of kind of how human resources would be applied here. And then the audit committee, each member financially literate with at least one financial expert. Sarbanes-Oxley basically made publicly traded companies have to have an audit committee. And an audit committee has to consist of at least 3 members, and they must have at least one financial expert, which means that they're a CPA or they've been a CFO or basically handled financial statements in the past. Like been a CFO in another company that would satisfy that requirement. Some audit committees will have 2 or 3 financial experts on them, but the audit committee again is kind of a separate part of the board of directors, and they basically hire the external auditors that come in to do the audit, and they also can work with internal audit. But basically, they're kind of the go-between external and internal auditors and the company. Like I said, internal auditors in some companies can report to the board of directors on the whole, but sometimes they also will report to the audit committee. Now, preventive and detective controls. Um, an organization should design controls that are both preventive and detective. Preventive controls basically stop something from happening. Like, for example, you can't be logged into two machines, or you can't put a you can't put a number in something that's designed for letters, or you can't put letters in a box that's designed for numbers, or your journal entry has to be in balance. Those would be kind of preventive controls. They prevent something from occurring. Detective controls basically are controls that put in place that recognize that something has gone wrong, and then the company can go back and fix it. Such as if you were producing a product, this would be like doing quality inspections, like after the product's produced. Oh, we've got a problem. This came out wrong. And then you'd go back and look at other products and correct it. So preventive and detective controls would be something that a company would establish. Detective controls might be also like, you know, getting a list of, employees that did something maybe, you know, um, that basically maybe set off red flags with their computer, went to certain sites or something like that. That would be like a detective control. Separation of duties. This is one of the most important control activities. And basically, when we're on control activities, think of these are the actual controls that companies are putting in place. We looked at the control environment in the first slide, which was the overall tone at the top and overall kind of mood within the company around controls. But these are the actual control activities that are going on within the company, the actual internal controls that are set up by the organization. Now, one of the most important would be separation of duties. And you want to separate authorization, custody, recording, and reconciliation. No one person should be able to do all of these. So kind of think of it this way. Um, there's several different examples I could kind of give you of this, but kind of think of this as if a company that I worked for in the past, um, basically we had a separate area that kept up with inventory. I was a controller. We had a separate part of the company that kept up with inventory. And basically there was like three people, and that was their jobs, to deal with inventory. And they could not authorize the purchase of new inventory, and they could not authorize the write-off of maybe inventory that was damaged, because they had custody of that inventory. They could not record new inventory coming in because they had custody of that inventory. They could not reconcile, what was coming in to what was going out. They could not record that reconciliation because they had custody of the inventory. So you want to separate these. Another case, I'll let you know of another story here that I actually got to work on the investigation, and it had to deal with, I was working as kind of an internal auditor for a company, and they managed, like, I guess, assisted living facilities across the US. And one of their facilities in Florida, their process, and this was back here in the 1990s. So you'll notice that they still got actual paper checks. The employees actually got checks sent to them. And so basically what would happen is their their bookkeeper would process the payroll. They would send it up to corporate, and then corporate would basically process the payroll, write the checks, and send it back to that bookkeeper. Then that bookkeeper would pass it out to all the employees. Now, think about that there. Bookkeeper processes payroll, sends it to corporate. Corporate sends the bookkeeper the checks, and then the bookkeeper passes out the checks. Can any of you see a problem? And I'll give you a second to think about it, as far as the separation of duties with what that bookkeeper was doing. There's a big problem there. Basically, the the bookkeeper was recording payroll, authorizing payroll, and also had custody of the checks. And so what happened was about, I don't know, about a year after um, this bookkeeper got started work, uh, one of the one of the employees that had left the company during the year called corporate and said, there is a difference between my last check stub and my W-2, because she was thinking, okay, my last check stub should equal my W-2. There's a difference. So we started an investigation. And what we found was basically the bookkeeper, whenever an employee would leave the company, she would always put in another 1 or 2 or 3 or 4 weeks work for that employee. And then when the checks came in, she would just pull them out because she knew that that employee was gone, sign them over to herself, and then cash it. And so she had got away with about $33,000 in the year that she was here, that she was with the company. I got to work on part of the investigation, and my office was like all of my office was like time cards, like boxes of time cards from this period of time. And I basically kind of found it was 33,000 and something dollars was the total. We were trying to figure out what is the exact total, um, and to charge the bookkeeper, in order to charge the case, how much it was. One thing about separation of duties, I will tell you, is that it's one of those things that sometimes companies don't think about it until something goes wrong. And basically after now all the company would have had to do that I was working for at the time was just have the bookkeeper process payroll, send it off to corporate, and then the checks would be sent to someone else. It could have been the HR rep at the home. It could have been the someone in management at the home could have gotten the checks, passed them out to everyone that where they went, where they needed to go. That's all that needed to occur. And so basically after that, the company changed their policy and they basically separated those duties. And so a lot of times with separation of duties, it doesn't really come up until there's a problem. Just something I've noticed from past experience. Now, another way is physical controls. And what physical controls are is that you just want to put physical controls in place in a lot of aspects of your company. Like, for example, your IT department typically is under lock and key. You might have to have a badge to access that area or some type of biometric identification. Um, you want your server room locked up. You don't want someone to walk in off the street and just walk into your server room. That's not good. And typically, also, I've heard that they like you to keep your servers in like a windowed area where you can see in there, where if someone was in there that didn't need to be in there, someone would see them. When I worked as a controller for a company, it was a company that managed vending businesses, all over Tennessee and Kentucky and North Alabama was kind of my region and the region that we covered at that office. And one of the physical controls we had in place was we had like a chain link area in that all the inventory was in, and it was locked, and the only people that could go in there was the people that were responsible for counting the inventory. I could go in there if I were like overseeing a count of the inventory or overseeing their count, which I did on occasion. But otherwise I didn't really have a reason. If I didn't have a reason to be in there, I shouldn't be in there. And by limiting access to that area, we probably saved a lot of inventory because going out the door, because it was like cases of Cokes and Snickers bars and all kinds of things of that nature. And we basically stopped a lot of that from, people going in there and just grabbing it. So we probably saved a lot of theft by having that, physical controls in place. So physical controls can be good. Typically HR has physical controls. You can't just walk into HR because there's a lot of employee identification there. So they typically keep the employee information like in locked closet and locked cabinets and things and limit access to HR. A lot of times accounting. I've worked in accounting offices where I had to either key in a code to get in or show my badge, swipe my badge to get in the door. So physical controls are actually good. Now, information system controls, these would be, login, passwords, firewalls, a lot of things of that nature that are very helpful in terms of information systems. Things like updating your password is good, and, training your employees on, what files they should open, what they should not open, and how to report phishing and things of that nature are good things to do. Those would be considered information systems controls. And monitoring, you want to basically evaluate controls and examine, are they working? And if they're not working, update those controls. They're just over time, especially when it comes to IT, you've got to be updating them regularly because things change very quickly in IT. So you've got to make changes to your controls to keep up with those changes. Um, Limitations on internal controls. Um, Monitoring I will say this, I'll jump back here real quick. Monitoring this is a lot of what internal audit does. They monitor the effectiveness of internal controls. They do reports, they test, are they working? Are there ways to get around the controls? They try to make the controls stronger. That's a big part of what internal audit does, or part of what internal audit does. Limitations on internal controls, collusion and management override. These are the two biggest ones. Collusion just means that most controls are made to stop one person from doing something. But if more than one individual starts working together in the right positions, they can work around controls. The example I was giving you a moment ago with the bookkeeper, how we change the controls where the bookkeeper sends payroll up to corporate, corporate then sends the checks to someone else. What if whoever we send the checks to starts working with the bookkeeper? Then they could work around the control. Controls are typically made to stop one person from doing something, but they can be worked around if two or more work together to work around those controls. And management override, this would be like you've got controls in place, but whenever they want to, different levels of management just override the controls and just push what they want through, regardless of the controls. That also is an issue. Now, the internal control evaluation. Terms like transaction level controls, these would be controls that relate to specific transactions or individual transactions that are made throughout a business. Entity level controls, these would be controls that relate to the company on the whole. A walkthrough, this would be kind of a way to test controls where you basically follow transactions through from beginning to end. And operating effectiveness, this would be, again, how effective are your controls? Are they operating as they should? You've got internal control questionnaires. And internal control questionnaires, just basically, this is something that auditors do. They will typically give these to different departments, and they ask the employees questions. And they typically set them up to where if there's a no answer to one of them, then that could indicate that there's a deficiency in controls and the external auditor should look at it. And so that basically you'll find external auditors do these a lot, the internal control questionnaires, just trying to look to see, are there any deficiencies in the controls? Internal auditors can use them as well. Now, narrative description of controls or flowchart the control system. This would be something that external auditors do. And internal auditors would do this as well. But what you're doing is a narrative description. You're going to describe like what controls are in place for this process, what controls are in place for this process. And you would have this list, narrative list of it. Or you would do a flow chart showing how controls exist throughout basically the entire system. And this is something typically that external auditors do, and they put it with their audit documentation to show that they've flow charted or have a narrative of this company's system of internal controls. They could even take last year's and update it as necessary. There's different ways that they could work with this. So 4 methods of testing controls: inquiry, it means you ask questions. Now, here's the thing: as an auditor, you can ask questions, but you want to verify the responses. Like I'm an external auditor, I could go ask the controller of the company I'm auditing a question, and I'll take their answer, but I'm also then going to verify their answer. I'm not just going to take their answer to be, it's kind of like, like trust but verify. I think Ronald Reagan said that. Trust but verify. That's kind of how you want to proceed as an auditor. So, observation, just observe the activities. If you want to see if a control is working, observe the control. Um, Document examination. Basically, as you're examining things and looking at things, you're documenting the process. You're documenting what you're doing. And and basically also with that, you're going to examine documents that the company's prepared. That's probably the best way to think about this. You will document what you're doing or write down what you're doing as the auditor. But in this case, think about it this way: if a company says they got an inventory, there should be basically a receiving report prepared by the company, and there should be an invoice coming from the outside supplier. So you could verify that that inventory came in by looking at examining those documents. Examine the receiving report prepared by the company and examine the invoice that comes from the outside vendor or supplier. Reperformance just means that you would reperform the action. And sometimes you'll see this in terms of like a bank reconciliation. Like you will look at that company's bank reconciliation, and then a lot of times you'll reperform it or verify every aspect of it to make sure the bank reconciliation is solid. Now, top-down approach to evaluate controls focuses on the threats to the integrity of external reporting process. Um, so basically, a lot of times you're going to take a top-down approach. You're going to start with controls at the top and work your way down. And think about it this way: if the controls are solid at the top, there's a greater chance they're going to be solid throughout the organization. Um, a couple of terms here: an internal control deficiency, a material weakness, reasonable possibility that a material misstatement would not be detected, and a significant deficiency. A deficiency, but less significant than a material misstatement. So these are two very important terms. And actually, if external auditors find a material weakness or a significant deficiency, they actually report it with the audit. And and basically with the audit of internal controls, these would be reported. And these are not good. If you're a CFO of a company and you have material weaknesses or significant deficiencies in your system of internal controls, it does not look good for you. Just saying that. So these are really what, if they find significant deficiencies, material weaknesses, the external auditor is required to report these as part of the audit of the system of internal controls. Auditor must offer an opinion on internal controls. It's either unqualified, which what unqualified means is that the system the system of internal controls is acting effectively. Adverse means that the system of internal controls is not acting effectively. A lot of times that would be due to a number or more than one material weaknesses or significant deficiencies within their system of internal controls to get an adverse opinion. Or a disclaimer of opinion. Disclaimer of opinion just means that for some reason the auditor, either due to the company's fault or the auditor's fault, maybe auditor independence, or the company does lost most of their records or won't give you access to records, you as an auditor cannot offer an opinion on the system of internal controls because you've not been able to properly evaluate it. And that is all. Internal controls is a great subject, and something that will help you, knowledge of, will help you in many areas of accounting. Take care. Bye-bye.